You spend $4 on coffee this morning without thinking twice. A boy in Omaha once spent that same $4 on a six-pack of Coca-Cola, walked door to door, and sold each bottle for a nickel of profit. That boy became the richest investor in modern history. The difference between you and him was never the $4. It was what happened to that $4 next. Are you ready to find out what your money is actually capable of if you just left it alone? Every fact you will hear today is built strictly on official financial records and personal interviews. You can find the exact source list waiting for you in the description below. Warren Edward Buffett was born on August 30th, 1930, in Omaha, Nebraska, into a household that understood money in two very different ways at once. His father, Howard Buffett, was a stockbroker who had opened his own investment firm right in the middle of the Great Depression, a decision that looked reckless to almost everyone around him. His mother, Layla, had grown up in a family that had lost nearly everything in the economic collapse of the 1920s, and that inherited anxiety about money shaped the household Warren grew up in. He was not born wealthy. He was born watching two parents process the exact same event, financial catastrophe, in opposite emotional directions. One parent saw opportunity in the wreckage. The other saw danger everywhere. Warren absorbed both lessons before he was old enough to spell the word portfolio. This is where the first calculation of the night begins, and it has nothing to do with billionaires yet. It has to do with your own household. Psychologists who study financial behavior call this process financial socialization, the quiet, often invisible transfer of money beliefs from parent to child before the child ever earns a dollar of their own. Studies on this topic consistently find that most core financial habits, how you feel about debt, how you feel about risk, whether you save automatically or spend automatically, are largely set before the age of 7. Not through lessons, through observation. If you grew up watching a parent panic every time a bill arrived, some part of your nervous system may still panic today, even if your bank account is healthy. If you grew up watching a parent invest calmly through chaos, you likely carry a version of that calm too. Before you optimize a single spreadsheet, it is worth asking yourself honestly what your household taught you to feel about money, because that feeling is quietly steering every financial decision you make today. By the age of 6, Warren Buffett was already running his first business. He bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents, split them into individual bottles, and sold each one for a nickel, earning a 5-cent profit per 6-pack. At 11 years old, he bought his first shares of stock, 3 shares of a company called City Service Preferred, at $38 a share. The stock dropped almost immediately to $27. Buffett held on, watched it recover, and sold as soon as it hit $40 a share, taking a small profit. Shortly after he sold, the stock kept climbing, eventually reaching over $200 a share. He later said that early sale taught him more than the profit ever could. It taught him the cost of impatience. By 13, he was filing his own tax return and claiming a $35 deduction for the bicycle he used on his newspaper delivery route. A route so efficient that at its peak, he was earning more from delivering papers than his own schoolteacher earned in a year. Now decode what actually happened in that city's service trade, because the lesson is mathematical, not emotional. Buffett bought at $38. It fell to $27, an unrealized loss of nearly 30%. He sold at $40, a gain of about 5%. Then it rose past $200, a gain of over 400% from his original purchase price. The dollar amount he actually missed by selling too early was larger than everything he had made from his newspaper route, his Coca-Cola business, and his pinball machine venture combined. This is the first hard rule of compounding, and it applies just as much to your retirement account as it did to an 11-year-old in Omaha in 1942. The money you make from patience is frequently larger than the money you make from labor. If you are working 40 hours a week to earn money and then trading in and out of investments out of anxiety, you may be working against your own capital instead of alongside it. Howard Buffett's job as a stockbroker meant that young Warren was exposed to something most children never see: adults discussing stock tickers, price movements, and company fundamentals at the dinner table as casually as other households discuss sports scores. He spent hours at his father's brokerage office, charting stock prices by hand before he was a teenager. This early, repeated exposure mattered more than any innate talent. Researchers studying expertise, including psychologist Anders Ericsson, have documented that what looks like natural genius in a field is almost always the product of thousands of hours of deliberate exposure and practice, often beginning far earlier than most people realize. Buffett was not born understanding the stock market. He was immersed in it before he had the vocabulary to describe what he was learning. And immersion, not talent, is what most separates people who feel comfortable with money from people who feel afraid of it. Here is the number that should genuinely disturb you, in a productive way. If you invest $10,000 today into a fund that returns an average of 10% annually, which is roughly the long-run historical average of the broader stock market, that money becomes just over $117,000 in 25 years, without you adding another cent. Wait 10 more years, 35 years total, and that same $10,000 becomes just over $281,000. The final 10 years alone generate more growth than the first 25 combined. This is not a rounding error. This is the literal mathematics of compound interest, where growth happens on top of previous growth, and the curve bends sharply upward only in its later years. The tragedy of most people's financial lives is that they quit, panic sell, or withdraw early during the flat-looking first 15 years, right before the curve does the majority of its work. Buffett has stated many times that over 90% of his personal net worth was built after he turned 50 years old, not because his strategy changed, but because that is simply where the compounding curve was mathematically positioned to explode. At the University of Nebraska and later at Columbia Business School, Buffett studied under an investor named Benjamin Graham, whose approach to the stock market was almost clinically unemotional. Graham taught a method called value investing, the practice of calculating what a company is actually worth based on its assets, earnings, and cash flow, and then only buying its stock when the market price sits meaningfully below that calculated value. Buffett was so determined to work for Graham that he offered to work for free. Graham initially turned him down, but eventually hired him at Graham Newman Corp., where Buffett spent years learning to strip emotion out of financial decisions entirely. He later described Graham's core lesson in a way that has nothing to do with stock picking and everything to do with psychology. The idea that the market is not there to instruct you, it is there to serve you, and whether you profit from it depends entirely on how disciplined you are, not how smart the market is. This is where you can build your own personal margin of safety, a term Graham coined and Buffett has used for 7 decades. In practical terms, it means never fully trusting a rosy projection and always asking, what if I am wrong? If you are evaluating any major financial decision, a home purchase, a career change, an investment, run the numbers assuming your income drops by 20% and your expenses rise by 10%. If the decision still survives that stress test, it has a genuine margin of safety. If it only works when everything goes exactly as planned, it does not. Most financial ruin does not come from a single catastrophic decision. It comes from decisions that had zero cushion built in for the ordinary bad luck that eventually touches every single life. In 1956, at the age of 25, Buffett returned to Omaha and started Buffett Partnership Limited, with just over $100,000 pooled from family and friends, of which his own contribution was only $100. Over the next 13 years, he grew that partnership at an average annual return that dramatically outpaced the broader market, compounding investor capital at roughly 29% annually before fees during certain stretches, though average long-run figures across the partnership's full life were lower once losing years are included. In 1962, he began buying shares of a struggling textile manufacturing company called Berkshire Hathaway, initially as a classic Graham-style value play on a cheap, undervalued asset. By 1965, he had taken control of the company. The textile business itself eventually failed and was shut down years later. But Buffett kept the corporate shell and used it as the vehicle to purchase entirely different businesses, insurance companies, candy makers, furniture stores, and eventually massive equity stakes in companies like Coca-Cola, American Express, and Apple. Berkshire Hathaway transformed from a dying textile mill into one of the most valuable companies on earth, a single share of which now trades for hundreds of thousands of dollars. Notice what actually happened there, because it is a lesson in flexibility, not stubbornness. Buffett did not succeed by refusing to change his mind about the textile business. He succeeded by being willing to admit the original thesis was wrong and redirect the capital somewhere better. Behavioral economists call the opposite of this the sunk cost fallacy, the tendency to keep pouring money, time, or effort into something simply because you have already invested in it, even after all evidence says you should stop. Researcher Hal Arks has spent decades documenting how this single bias quietly wrecks retirement accounts, small businesses, and relationships with money. If an investment, a business idea, or even a career path is no longer working, the years you already spent on it are gone, regardless of what you decide next. The only question worth asking is whether continuing forward from today makes sense, not whether abandoning it would waste what came before. One of Buffett's most famous acquisitions was GEICO, an insurance company he first discovered as a 20-year-old graduate student, when he took a train to their headquarters, uninvited on a Saturday, and convinced a janitor to let him in to speak with an executive. He bought a small stake then, sold it years later for a profit, and then, decades afterward, used Berkshire Hathaway to acquire the entire company outright. Insurance became the quiet engine underneath Buffett's entire empire, because insurance companies collect premiums up front and pay out claims later, meaning they sit on enormous pools of cash, called float, that can be invested in the meantime. Buffett effectively discovered a way to invest with other people's money, legally and structurally, at essentially no cost, and he compounded that float for over half a century. Translate that insurance float model into something usable in your own life, even without owning an insurance company. The principle is this: look for financial structures where you get to use money before you have to pay it back, at zero or near zero cost, and put that money to work in the meantime. A 21-day interest-free window on a credit card, used responsibly and paid in full every single month, is a tiny personal version of float, assuming you would have spent that cash anyway. An employer 401k match is a more powerful version, essentially free capital handed to you the moment you contribute, often an instant 50 to 100% return before the market does anything at all. If your employer offers a match and you are not contributing enough to capture the full amount, you are leaving guaranteed, risk-free return sitting on the table, something even Buffett himself has called one of the simplest wealth-building tools available to ordinary people that many simply never claim. As Buffett aged, his lifestyle became almost a case study in restraint that ran directly counter to his growing net worth. He continued living in the same modest house in Omaha that he purchased in 1958 for $31,500, a house now worth a small fraction of 1% of his total wealth. He has been photographed for decades, driving relatively modest cars and eating at the same local steakhouse. This is not frugality for its own sake performed for cameras. It reflects a specific psychological principle researchers call hedonic adaptation, the well-documented tendency for humans to quickly return to a baseline level of happiness, regardless of new income or possessions. Studies tracking lottery winners have repeatedly found that after an initial spike, happiness levels return close to where they started within roughly a year, while the financial risk of the new spending habits often remains permanently elevated. Buffett appears to have understood intuitively, decades before the research existed, that lifestyle inflation is a treadmill that consumes wealth without producing proportional happiness in return. Run this calculation honestly against your own life, because it is where most people quietly lose the compounding game before they even notice it happening. Assume your income rises by $5,000 this year through a raise or bonus. If your spending also rises by that same $5,000, your net financial position has not moved at all, despite the raise feeling like progress. Now assume instead you invest just half of that increase, $2,500, every year for 30 years, at a 7% average annual return. That habit alone grows into roughly $250,000, built entirely from money you would never have missed, because you never adjusted your lifestyle to depend on it in the first place. The gap between people who build wealth and people who simply earn a high income is rarely the size of their paycheck. It is almost always the size of the gap they maintain between what they earn and what they spend. Buffett has also been unusually transparent about his mistakes, something that runs against most public narratives of billionaire success. He has openly called his original purchase of Berkshire Hathaway's textile operations one of his biggest errors, estimating it cost him billions of dollars in opportunity cost compared to what that same capital could have earned if deployed elsewhere immediately. He has also acknowledged buying into companies like Dexter Shoe using Berkshire stock, a deal that later proved costly, precisely because that stock itself became so much more valuable over time. He writes about these mistakes openly, every year, in his shareholder letters. This willingness to publicly dissect his own errors reflects a concept psychologists call a growth mindset, a term coined by researcher Carol Dweck, describing the belief that ability and outcomes can improve through honest reflection rather than being fixed traits to be defended at all costs. People who treat a financial mistake as proof they are simply bad with money tend to repeat that mistake. People who treat it as data tend to correct course. Here is the final calculation of the night, and it echoes all the way back to that 6-year-old boy selling Coca-Cola door to door. Time is the single input in the compounding formula that money itself cannot buy back once it is gone. A 25-year-old who invests $200 a month at a 7% average annual return will have close to $500,000 by age 65. A 35-year-old starting that exact same monthly habit at the exact same rate of return ends up with roughly half that amount, closer to $240,000, despite investing for only 10 fewer years. 10 years of delay does not cost you 10 years of growth. It cost you the 10 years when the compounding curve was mathematically positioned to do the heaviest lifting. This is why Buffett has said, in more than one interview, that the best time to plant a tree was 20 years ago, and the second best time is today. But knowing the mathematics of the compounding curve is entirely different from surviving it. Most people fail this test not because they lack intelligence, but because they lack a systematic defense against their own emotions. If you want to build a portfolio that survives decades, you need to automate your decisions before the panic arrives. Here is your immediate, non-fictional checklist to transition from a consumer to a compounding engine today. First, define your baseline gap. Look at your bank statements from the last 90 days and find the exact average mismatch between what entered your account and what left it. If that gap is zero, your first financial move is not buying a stock. It is freezing your lifestyle at its current level during your next inco. To genuinely answer that question, you must undergo one final psychological shift, from judging your life by price to judging it by value. Buffett famously quoted his mentor Benjamin Graham by saying, "Price is what you pay. Value is what you get." Most people live their lives entirely trapped in the world of prices. They see a discount on a car, a sale on a luxury watch, or a drop in a stock price, and they react entirely to the tag. They measure their financial status by the speed at which they can exchange their hard-earned cash for depreciating objects. A compounding mind operates in reverse. Every time you open your wallet, you are not just purchasing a temporary item. You are executing an asset allocation decision. You are choosing to destroy the future compounding potential of that capital in exchange for instant gratification today. If you pay a premium price for something that delivers zero structural value to your life, you are running a negative margin of safety. You are quietly bleeding your personal float. True financial independence arrives the moment you realize that the ultimate asset you are trying to acquire is not a luxury lifestyle. The ultimate asset is control over your own time. When you systematically maintain the gap between what you earn and what you spend, you are slowly purchasing your freedom from corporate structures, from financial anxiety, and from forced labor. You are building a personal insurance company where the premium you pay is restraint, and the guaranteed payout is absolute autonomy. Wealth is never what you spend. Wealth is the invisible baseline of choices you have accumulated, but chosen not to use yet. Protect your time, protect your gap, and let the math do the rest.